Hello everyone. Welcome to another video about investments. Today, we're going to talk about a very important topic for investors, the impact of the economic cycle on investment decisions. First of all, it's important to understand what the economic cycle is. It consists of 4 phases: expansion, peak, contraction, and depression. Each of these phases has a significant impact on the economy as a whole, as well as on different sectors and financial assets. But before we begin, please subscribe to our channel and like the video to help us grow. In the expansion phase, the economy is growing, income is increasing, and the unemployment rate is falling. Businesses are doing well, companies are generating profits, and investors are optimistic about the future. This phase is usually accompanied by an increase in consumer and business confidence, which leads to an increase in consumption and investment. For investors, the expansion phase can offer favorable investment opportunities, especially in the stock market. During this phase, stocks tend to perform better than other assets, such as treasury bonds. In addition, companies can increase their dividends and buy back shares to reward shareholders. Some examples of favorable investments in the expansion phase include technology company stocks, which often benefit from increased consumer consumption and confidence, as well as consumer-focused companies such as retailers, which benefit from increased consumer purchasing power. It is also possible to invest in infrastructure-related sectors, such as construction, which tend to grow during the expansion phase, driven by increased investment in infrastructure. During the peak phase of the economic cycle, the economy reaches its highest point but begins to slow down and prepare for the next phase. In this phase, investment opportunities may become more limited and risky. Some possible investment opportunities during the peak phase include rising sectors. Even as the economy begins to slow down, there may still be specific sectors that are on the rise. Investing in stocks or funds that track these sectors may be an option. Safe assets. With the economy at a peak, investors may want to reduce their exposure to risks and invest in safer assets, such as treasury bonds. Infrastructure investments. Infrastructure projects tend to be more stable and predictable, and can be an option for investors seeking long-term and safer investments. It's important to remember that, just like in the expansion phase, each economic cycle may have its own peculiarities and specific investment opportunities. Investors should always carefully evaluate market conditions before making investment decisions. During the contraction phase, the economy begins to show signs of slowing down and growth begins to decline. This period can be challenging for investors, as many financial assets may be experiencing losses. However, there are investment opportunities to be explored in this phase. One strategy that investors can adopt is to invest in assets that may benefit from a reduction in interest rates. When interest rates are lowered, the cost of borrowing becomes cheaper, which can stimulate demand for certain sectors, such as real estate and construction. Additionally, companies with low debt and strong cash flows may be well positioned to benefit from the fall in interest rates. Another option is to invest in assets considered defensive, such as treasury bonds or high-quality fixed income funds. These assets usually offer lower returns but are also safer and can help protect wealth during periods of market volatility. Finally, investors may also consider investing in companies with a strong global presence, which may be less exposed to economic conditions in a particular country or region. This can help mitigate risks associated with economic slowdown in a particular region or sector. In the depression phase, the economy as a whole is going through a tough time, with businesses suffering and the stock market in decline. However, this does not mean that there are no favorable investment opportunities during this phase. One opportunity is to invest in companies with strong fundamentals that have been undervalued by the market downturn. These companies may recover in the future and generate significant returns for investors who entered during the low point. Another opportunity is to invest in safer assets, such as treasury bonds, which can provide a stable income stream during times of crisis. In addition, sectors that show resistance to recession, such as healthcare and basic consumer goods, can be a good investment option in the depression phase. These sectors may maintain relatively stable performance even during an economic crisis, offering a safe haven for investors. Finally, real estate purchases can also be a favorable option in the depression phase. As real estate prices tend to fall during this period, investors may find opportunities to buy real estate at lower prices than usual. Over time, these properties may appreciate again and generate good returns for the investor. When making investment decisions, it is crucial to evaluate the current economic cycle and how it may affect your investments. There are several factors to consider when assessing the current economic cycle, including interest rates, inflation, unemployment, and sector economic indicators. Interest rates, for example, have a significant impact on the economy and the investment market. When interest rates are low, companies can access cheaper capital, which can encourage business expansion and increase demand for products and services. This can be a favorable opportunity to invest in stocks and equity funds. On the other hand, when interest rates are high, it may be more difficult for companies to obtain financing, which can lead to an economic contraction and a drop in the stock market. Inflation can also affect the economy and investments. When inflation is high, prices of goods and services increase, which can lead to a decrease in demand for those products and services. This can have a negative impact on companies, leading to a drop in stocks and equity funds. However, during periods of moderate inflation, some investments may be favorable, such as inflation-indexed bonds. In addition, it is important to evaluate the unemployment rate. When the unemployment rate is high, there may be a decrease in demand for products and services, which can lead to a drop in stocks and equity funds. However, during periods of low unemployment rate, demand may increase, which can lead to an increase in stocks and equity funds. Finally, it is important to analyze sector economic indicators such as gross domestic product, GDP, consumer confidence index, and price indices to understand the direction of the economy. For example, if the GDP is growing, this may be a positive signal for the economy and for investments in stocks and equity funds. In summary, evaluating the current economic cycle is essential for making informed investment decisions. Factors to be considered include interest rates, inflation, unemployment, and sector economic indicators. Understanding how these factors can affect different investments is crucial in choosing the best investment options for each phase of the economic cycle. In conclusion of this video, we can recap the main points that were discussed. Firstly, we saw that the economic cycle is composed of 4 phases: expansion, peak, contraction, and depression, and each one has a significant impact on the economy as a whole and on different sectors and financial assets. Next, we explored investment opportunities in each phase of the economic cycle, from investments in stocks and real estate during the expansion phase to investments in treasury bonds during the depression phase. Finally, we discussed how to evaluate the current economic cycle and the importance of understanding economic conditions before making informed investment decisions. Therefore, it is important for viewers of this video to carefully consider the current economic cycle and the factors that influence it, such as interest rates, inflation, and unemployment, before making any investment decisions. By doing so, they will be in a better position to maximize their financial returns and minimize risks.